Breakouts are very easy to spot in Forex trading, in my opinion, once you get a little bit of experience. In this video, I'm going to show you how I do it. If you're new to my channel, welcome. My name's Nick. I'm just some bald guy who trades. I've also had a free Telegram channel for the past 6 years. I share all my analysis in this free Telegram channel. There's like 61,000 members in it right now. It's all for free. It's all daily. In some cases, I even sent as a 13-minute audio message here explaining one little piece of analysis. And I also show my terminals, my P&L history, the results. And if you also want to follow my trades live, I have a private Discord server where I just share all my trades live and all the exact trades that I take specifically. So if you want the analysis, it's free. You can just click the first link in the description of this video. I'll also put it in the pinned comment. You can learn everything that you're about to learn in this video. You can actually follow it for free in my Telegram channel. So with that said, let's go ahead and get right into it here. Breakouts. So breakouts are one of these things where you look at a chart, you see that price continues to hit one area over and over and over, and it doesn't fall from that area. Usually after that, a good chunk of the time there's going to be a breakout. Now, in order to kind of put this into perspective here, keep in mind, trading is risky. Most people lose money, and you're probably going to lose money even if you follow everything I say in this video. Trading is hard. Almost everyone fails. Over 90% of people lose money. Now, with that said, I'm just going to show you what works for me here in this video. So you have a resistance zone. Price comes up and it touches the resistance zone. Then it falls a little bit. Then it comes right back up and touches the zone again. Then it falls a little bit. Then it touches the zone again, and it keeps on banging into the resistance zone over and over again. A good chunk of the time, provided that you have the context of experience to start kind of making a discretionary decision as to whether or not you should take a trade or do anything, provided you have experience, you can kind of it helps you predict that price might be more likely to break a zone or not. The same is true vice versa for support. Now, this is something that I've coined on my channel like 2 years ago. It is a phrase that I came up with, or like a statement, or like a quote, you could call it. And the quote goes as such. It says, the more a support resistance zone is tested, the less likely it is to be respected. Now, if we're going to put that into practice here on the chart, a very simple way for you to see this is, let's say there's a support zone. When price comes into a place that you think it's likely to bounce, we're just going to call this a support zone to keep it nice and simple. If you think it's going to bounce there, well, price is going to go there and then it's going to bounce away. Gold sticker for you. It goes and then it bounces. Now, sometimes price will not bounce immediately, right? Sometimes price will bounce up first. Then it will come test the zone. Maybe it'll go a little bit below it, but then pop right back up. And then it makes essentially what you'd call a double bottom or head and shoulders or some sort of reversal pattern that everybody brags about, that they can predict the market with some sort of a reversal pattern. All I'm saying is that if price comes into a zone that you think it's going to bounce at, whether you think it's going to bounce up or down, it's probably just going to go there and then bounce up or down. The interesting thing comes in is whenever price gets into a zone like this, keeps trying to bounce, then it keeps on banging into the zone like this, like it's going to make lower lows and lower highs, and then you have a breakout. Now, what are different ways you can profit from something like this? Well, you could take a trade to profit from the actual breakout. It's probably the most straightforward way to trade it. The second thing you can do is it kind of helps you make trade management decisions. I'll give you an example. Let's say that you get into a buy right here. So the buy, we're at this little nice little purple area right there. So you buy, you think price is going to bounce, but then it comes, and then instead of actually having a nice move up, right, instead of any of that happening, all price does is it keeps on coming and testing the zone, keeps on bouncing, keeps on going sideways. So then you elect to close the trade at break even. Now, of course, as soon as you close the trade break even, price could then have the move up and just rocket up, right? You're never going to be able to predict it 100% of the time, but this could help you peel risk off the table because it might prevent you from taking a needless loss. If you have a stop loss below the zone and a target above the zone, well, closing the trade at break even and peeling off the risk and just going to a different trading opportunity where you can get in and it just so happens to bounce immediately, you kind of want to optimize for that. You don't really want to be sitting in trades that are kind of less likely to work as price action develops and gives you evidence about what price is trying to do. And you want to move your trading capital and allocate your margin and leverage to trades that are more likely to work and more likely to be in and more worth being in. So I'll give you another example. Let's say you're short somewhere up here, right? Price has maybe this was another support resistance zone and price just kept on bouncing at it. So you thought it would go down. So you entered a short position. Maybe you entered a short position on the breakout. So short position goes and it breaks out and it comes down here to this next zone. And you're asking yourself, should I close here? Because your final target might be much lower. It might be based on some higher time frame, like the daily chart. We might be looking at in this example, like the 1 hour chart, right? So it goes to the support zone. Now you have a decision to make. You can either close the trade there. You can close partial profits of the trade there, something that I don't usually do. Or you could hold the trade. You know, what are you going to do? Now, context of experience requires that if you have that, then you can make a decision that is more likely to be the quote best decision given the context and the specifics of the trading opportunity. However, if you're using this thing of like, okay, price went into the support, it tried to bounce, then it came back and tried to bounce again, then it tried to bounce over and over and over again. The idea would be that, okay, you feel safe staying in this trade because price continues to just bang into the zone and it fails to break out upwards and it just keeps going sideways. And so it just makes it more likely for the trade to work, to continue into more profit. And then maybe you get to like a final zone down here where it's like a big weekly or daily zone. Then price gets there, then you can close down there. So now you've had your final profit target reached and you were able to capture more profit on that particular trade. And we haven't even talked about if you add to that trade, if it looks like it's going to break that zone again, you can capture effectively more profit from the move if you can kind of like sort of predict a little more than 50% of the time after getting a ton of experience whether or not a breakout is going to occur. I have to say all those caveats here because this does not work every time, right? There are times where price will do exactly this and I don't close the trade. I'll give you an example. The USD CAD trade that I am in right now, I'm heavily short in this general region right here at this resistance zone. So the reason I'm heavily short in here, you probably could have seen at the beginning of the video in my when I showed the Discord history of the Knicks trades group. But the reason I'm heavily short right here is this is a weekly zone. So price has gone up here. We've bounced around this zone multiple times as resistance and support, then resistance and resistance and support. So we've come up here and we've bounced as resistance. We had 1 week of a closure right there. We had price spike deeper into the zone in which I added last week. And we're still having price reject the zone. Now, could price still go up, right, against all my sell positions? And then I have to go to the next recovery trade zone or add a trade and then manage the positions if it starts to fall back. Sure, all that could happen. But I haven't closed this trade because I think it is more likely that price is to bounce at this zone downwards than to go up. I'll also give you another example. I was in a buy down here and my first buys were down here. I closed at break even. And then these next ones over here, I entered as price was going up. So a reason I stayed in these buys that gave me good quote evidence or good quote like reason to stay in it is because of a couple things. So right here, here's a set of highs. There's a high there, a high here, a high here. As price kept banging into this resistance zone over and over, price started making higher lows and it just looked like it was going to go up. Now, again, this is super subjective. Yes, I get it. Are there any black and white rules and criteria and absolutes you could put around this? In my opinion, no. It just takes getting experience. But whenever you start noticing the context of everything, such as, price is at a major support zone where it's had big bounces multiple times in the past, broke through, had another big bounces multiple times here, went all the way up here, like hundreds of pips. It's like 170 pips. Given that context, and then given the fact that on the lower time frames, like the 1 hour, price continues to bang into a resistance zone, that quote emerges. The more a support or resistance zone is tested, the less likely it is to be respected. If price comes and tests a zone once or twice, then bounces, that's fine. That's fair game. Take your trades. If price comes into a zone and then it's like bounced away from the zone a small amount, but it keeps coming back, it's happened like 5, 6, 7 times. In my opinion and in my experience, it's usually not a great idea to try to either short from that resistance zone or buy from that support zone. If you've already captured some profit, right? It came to support, you bought, had a nice move away, and then as soon as you close in profit, very quickly after that, it comes all the way back to the zone very quickly. Those are usually not trades to like sort of retake, right? Or re-enter where you're buying from the same zone again. The more a support or resistance zone is tested, the less likely it is to be respected. This one quote kind of helps you parse out all of that. Again, you're going to have to go and get your own experience doing this and sort of accumulate that data to try to help find out. But I used this thing. I didn't realize how much I actually did it till one of my clients pointed it out last week and said, like, Nick, how do you know whether or not a support or resistance zone is going to break? So I started to think about it. And then I came to all these things that I'm teaching you here in this video. The price action that price paints whenever it gets to the zone is kind of the biggest indication of what is likely to occur. And it's mainly this little pattern of when you see that price keeps banging into the zone over and over. In this case, 1, 2, 3, 4, 5, 6 times around these highs before it broke out. If you want to be super granular and detailed, which I don't like being just because price, you can easily get confused if you start trying to be way too specific. Um, you could say that price was banging into this resistance zone, then it broke past the resistance zone, and then it came back to retest as support. So then you have a kind of a break and retest trade as it goes up. But even if you're saying that, the same thing applies at the next set of highs that happen, right? Price got hit at this next set of highs. It hit the highs. It had a nice little bounce away. Came up, had a smaller bounce, had a smaller bounce. It just kept on making higher lows. And then it kept banging into this zone 1, 2, 3, 4, 5, 6 times before it finally broke out above it. Came back for a retest and then tested it. For some reason here, price just decided to stop. This also highlights the point that if a trade is going to bounce at support resistance, meaning that if you get into a trade at support resistance, if you're going to be right in general, save for anomalies and things that do not apply to the rule because trading is super subjective, in general, price is going to have a bounce relatively quickly. I'm using extremely subjective terms, I know, but that's just the nature of manual trading. Everything's subjective. In general, if you're right, price is going to bounce pretty quick at a support resistance zone. That's all I'm saying. If for some reason a person sold up here, I didn't. I'm not saying this would be a good trade or anything. I'm just saying it for the sake of an example. It hit this zone, then it had a bounce away, then it came back and bounced a second time and then pulled away pretty quickly. Now, whenever you have something like this, where price comes into a resistance zone and it keeps on trying to bounce over and over, if price is going to go, it'll do it either the first time or it'll do it the second time right here. And then sometimes it'll go a third time. Usually once it starts getting to 3, 4, 5 times, that's when in my opinion, it's better to not take a trade at the zone. But if you're going to be right, the easiest trades will be you enter and they just start going into profit. How crazy would that be? You buy at support and it bounces and it just goes into profit. Those are going to be the easiest, best trades that have the shortest trade duration, and you generally capture the most profit on those trades, in my experience. Just saying, this is what works for me. So in that case right here, you can see that price did not do that. It did not go down. It just kept going sideways, kept banging into the resistance zone over and over and over. Then we had a continuation higher. Now we have this very interesting situation where even though price continues to bounce in this general region, I'm not closing my trade because I still think it's going to bounce, but that's because I've used the context of the higher time frame where I think on the weekly and daily chart, this is a major area prices had big consistent bounces. I don't think it would be the best idea to close here. So again, this is where you have to exercise a little bit of discretion and intuition. What you can do is you can go and test this for yourself. Make sure you're using either a demo account or like a very, very small live account that you are 100% comfortable losing. Maybe that's $100, $500, $1,000. It needs to be something that literally you could lose and not even bat an eye and not worry about it for even a single moment if you lose the account or if you take huge losses on the account and blow it. So once you're testing in that context with something you're comfortable with a risk that you're comfortable with, or in a demo account, it's my personal favorite because there's literally no monetary risk at all. You can start testing this out and start seeing, okay, if I get into a trade and then it comes up to this next area where it starts to find resistance and I'm going to buy down here, at that resistance area, is it having big bounces or is it just these small little bounces kind of going sideways, but kind of with a little inclination to the upside? Maybe it's making like higher lows into the resistance zone. You can start making decisions like, well, would it be a better idea to close here or not? If you think that it's going to break the resistance zone, you can stay in your trade, and then boom, it goes to the next area. Then it starts finding resistance somewhere. Maybe it's just made a higher high. Maybe it's the top of a channel. Maybe it's your Fibonacci extension. Maybe it's the resistance zone that's next, or maybe it's the institutional order block, ICT, fair value gap, smart money distribution concept, institutional liquidation, stop hunt, spike, manipulation candle entry up there at the top. Whatever it is, whatever the hell you think it is that price is going to bounce at, I just call it a resistance zone because it functions the same as anything else you could use. If it goes there and you think it's going to bounce, if you watch price action and you just see that it's going sideways at that zone, in my opinion, save for context, like, it's a major weekly zone or something, in my opinion, it's likely to keep going, right? It's just speaking from my experience. You can start using this to capture more profit on trades that are profitable. You can also start using this to get out of trades that are either losing at a smaller loss or trades that are going sideways around break even, small profit, small loss. You can just scratch those out around break even because you bought at support and then it's going sideways, or you sold at resistance, but then it's going sideways and you just close it. So you can capture more profit on winners and you can lose less on losers. And you can also make better trade management decisions because you can shorten the trade duration. If you see a trade's not working, it's just going sideways, you can just decide, you know what, I'm just going to get out of this trade. I'm going to find another trade that seems to work out better, and you just take that trade. It is something that has really shaped a lot of my trade management decisions in particular. As far as entries go, I usually like being the person that gets in like on that first impulse. just because like as soon as price snaps into a new area, like it makes a higher high and I sell, or it makes a lower low and I buy, or if it's like, if it's in, say it's in like a really clear trend, then it has a quick snap to the upside and then I sell really quickly, and then I have a plan for managing it if it goes wrong. Whenever I get into things like that, I find those work out the best, like the first impulses. I don't find it's good to start trying to counter the market if it's just going like ranging sideways. Now, again, I know this is all subjective. You can follow all this for free, the analysis in the Telegram channel. I really take my time and I try to be as detailed as I can in sharing the analysis. And then if you just want to, if you're trying to test this for yourself and you want to see my exact trades and literally see me trade live with all my terminal P&L history, you can see the whole trading, like you can see the whole server history since I started it earlier this year. Then you can just join the Nick's Trades group. That you literally see every single one of my trade management decisions live, and I use concepts exactly like this. So with that said, go test this out for yourself. I think it's a great way to kind of learn where price might be about to break out, and it can just help you make decisions that from a risk perspective are better, in my opinion, like closing trades that are not as good early, or staying in trades that look pretty good longer and capturing more profit on them. Who wouldn't want to capture more profit on their winners, and who wouldn't want to make their losers smaller? It is what it is. That said, if you enjoyed this video, I'm happy you did. Hope to see you in my free Telegram channel, and I'll see you in the next video. Have a good one.